Natural gas nightmare. Last week, a fire broke out at the Freeport natural gas terminal located in Quintana, Texas. Thankfully, no injuries occurred, and there's no risk to the surrounding area either. But in the wake of this incident, U.S. natural gas prices fell. As you can see on the chart, this might be surprising to you. Wouldn't a natural gas facility going out of commission cause prices to go up, not down? Well, here's the catch. What went out of commission wasn't just a regular natural gas facility. It was an LNG export terminal, one of just 7 such terminals in the entirety of the U.S. With that export terminal out of commission for at least 3 weeks, about 1/5 of total U.S. LNG export capacity is gone out with it, thus leaving about 2 BCFs, 2 billion cubic feet of gas per day stranded in domestic U.S., as the table you're looking at right now. This is good news for the Americans' pocketbook. That gas being stranded on home soil is the reason why U.S. gas prices pulled back last week. But for Europe, which has already been seeing higher gas prices in the wake of the war in Ukraine and sanctions on Russia, the opposite is true. Gaslighting. The EU just can't quit Russian natural gas dependency. There's been a lot of strong rhetoric from Europe over the past several months as the situation in Ukraine has dragged on. Unfortunately, many people say what they'll do, but not many people do what they actually say. In May, Russia cut its gas supply to any EU customers who weren't willing to pay their bills in Russian currency, the ruble. Poland, Bulgaria, Finland, and the Netherlands have seen their supplies of Russian natural gas dry up after refusing to bow to Putin's demands. But plenty of other customers from countries like Italy, Germany, France, Hungary, Austria, and many more have opened ruble accounts with Gazprombank, or even negotiated some form of alternative payment schemes to bypass the sanctions against Russia. Now, these new arrangements may comply with the letter of the law when it comes to the EU's sanctions on Russia, but it certainly does not follow the spirit of the law, nor does it at all line up with what the politicians have said. Getting high on supply. The EU has been happy to impose harsh sanctions on Russian oil and coal, but they've been much more skittish when it comes to Russian natural gas. Now, I wrote about this many years ago in my first book, The Colder War. And look at this chart that we've updated here for you. That's the Russian flag, and in the background, you can see that today, still today, Russia supplies around 40% of the EU's demand for natural gas. That's why the EU can't afford to completely cut Russia off just yet. They're simply too important for the EU to get aggressive with sanctions on natural gas. And look at this chart right here. The EU gas prices are skyrocketing. And when things like this happen, there's massive voter turnout and change of government, and the politicians are rattled. This certainly sent natural gas prices skyrocketing at the outset of the war. Though prices have since pulled back to pre-war levels, they still remain very elevated when compared to historical prices over the last 5 years. Even before the war in Ukraine, low natural gas inventory levels, supplier shortfalls, high electricity prices, and a colder winter had all contributed to record highs for natural gas prices. Russia's actions only served to further exacerbate a problem that was already there for the European continent. Back at home, things aren't rosy either. Keep in mind, when I mentioned that the U.S. natural gas prices fell in the wake of the news about the fire at the export terminal in Texas, U.S. natural gas future prices are still up more than double from the beginning of the year. The recent pullback didn't fix the natural gas pricing situation at home. It was more of a brief respite. We're not quite at all-time highs for natural gas prices at the Henry Hub, which were set during a brief spike last February when an intense winter storm battered Texas. The outlook for natural gas prices still remains high. The US EIA, that's the Energy Information Administration, expects the domestic gas prices to stay about where they are for the foreseeable future, holding north of $8.60 per million BTU for the third quarter of 2022. This is high. This would be going into winter. Increased foreign exports and heightened domestic demand as gas to coal switching becomes less and less available are all to blame. But while this doesn't sound like great news for consumers, trouble has always ridden hand in hand with opportunity. Look, I've been following the natural gas, resource, and energy markets for over 2 decades now. And all the past few years haven't been kind to oil and gas companies. The world isn't ready for them to go away of the dinosaur just yet, as the EU is clearly showing. Our eyes are on select targets in the industry. It's very unconventional, and I can guarantee you nobody else in the business is even aware of this opportunity. And I've got the capital ready to pull the trigger at the prices that I like. If you want to know what moves I'm making, you can see all my research on oil and gas, and even the exact companies I'm positioning into to maximize my own financial returns in the current market dynamics. Please click here and stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.